I think that it's much more to do with the former, which is the fact that companies need a good business model. They need a path to profitability. They need a path towards good gross margins, good net margins. And if they don't have that, the market's going to speak. I think that, when you're a private company, you don't come under so much scrutiny. You've got a lot more time to determine your business model, a lot more time to think through, how do we make money? But once you're public, you're under scrutiny. And, at Inside Partners, when we look at what we invest in, we very much think that it behooves us as investors to think about and do good due diligence on the kind of companies that have great business models, that have good management and a good path to profitability.
I would think VC firms, I would think the likes of a Fidelity Growth Fund, I would think that they would all do pretty good due diligence when they're putting a bunch of money into some of these privately held companies ahead of the IPO, Hilary. And so I'm wondering, is it a pressure to deploy capital, that there's just so much capital out there sloshing around because of this era of low interest rates that people are chasing returns and so willing to sort of suspend disbelief when it comes to investing in some of these companies?
You raise a really good point. I think lots of these companies are looking to put money to work before the IPO with the hope that it'll pop upon IPO. And so some of these valuations that are pre-IPO, the mezzanine rounds, they've been done at these huge valuations because companies like Fidelity are looking to put money to work. I think that's a really good point. When you get to something like a direct listing, though, what you do really is take out that pop and you give the money back to the company. So we're starting to see that the markets are getting smart, and at least the companies are getting smart about the fact that there are alternative paths to liquidity. One is to stay private, and there's lots of venture debt available for those companies that are good. And another is to think about going public with all the scrutiny that involves.
Hilary, I'm sure you've had hits and you've probably had some swings and misses. What do the hits have in common, and what have you learned from the misses? What do the misses have in common?
Great question. So the hits are very much have the same things in common. Whether it's a company that is a SaaS software company, and we mostly invest in software. And I think that's where alludes to your question, which is not all technology is created equal. Something like a software as a service business model that Insight invests in, there's a lot of predictability in the revenue streams. There's a lot of recurring revenue. You have a lot of forward 12 visibility as to what the company's going to perform at. Whereas some of the other technology companies that have less common business models, take Peloton, for example. They're both a media company, they're an apparel company, they're a hardware company. Much more difficult for investors to determine whether those companies and how they're going to make money long term and what the gross margins will be long term. So when we look at companies, I think as investors, we're looking very much for companies that have this kind of predictability in their revenue model.